let's talk about the stock market. I know, it sounds super complicated, right? Like something only geniuses in suits really understand. But what if I told you it's actually way simpler than you think? By the end of this, I promise you'll get the big idea behind it all.
Okay, let me ask you something. Have you ever looked at a giant company like Reliance or TCS and thought, man, I wish I could get a piece of that action? What if you could, with just 1,000 rupees? Sounds kind of crazy, right? Almost like a fantasy.
Well, guess what? It's not a fantasy at all. The answer is a huge yes. You absolutely can. And the magic key? It's something called a share. That one little thing is your ticket to owning a tiny piece of some of the biggest companies out there.
All right, to make this crystal clear, we're going to use what I call the pizza slice principle. Trust me, it's probably the easiest way you'll ever hear this explained.
So first things first, picture a company, any company. Now imagine that entire company is one big whole pizza. It's one single entity with everything, all its buildings, employees, and ideas baked right in. Okay, so if the company is the whole pizza, what's a share? You guessed it, it's just one slice of that pizza. When you buy a share, you are buying one slice, and that makes you a part owner. You literally own a piece of the whole company. Yep, it's really that simple.
Okay, awesome. A share is a slice of the company pizza. Got it. But where do you actually go to get your slice? You can't just walk into their headquarters and ask for one, right? Nope. For that, you need to go to the marketplace.
So how does this all work? Well, it usually starts with something called an IPO. That's an initial public offering. This is like the company's big debut party. It's when they sell their first slices to the public to raise a bunch of money. After that, those shares get listed on a stock exchange. Think of it as a huge online market, like the NSE or BSE here in India. And here's the cool part. From then on, you're not buying from the company anymore. You're actually buying and selling those slices with millions of other people every single day.
All right, this is the part everyone wants to know about. You've got your slice of pizza, now what? How does this little slice actually earn you money? Well, there are two main ways this can happen.
First up is what everyone talks about, selling high. The idea is simple. You buy a slice when the price is low. Then, if the company does really well, more people are going to want a slice of that pizza, right? That demand drives the price up, and that's when you can sell your slice for more than you paid for it. Boom, profit. The other way is by sharing the profits. See, if the company is making good money, they might decide to share some of that cash with their owners, and that's you. That little bonus payment is called a dividend.
Okay, so we've covered all the good stuff, the exciting ways you can make money. But, and this is a really big but, we have to have a serious chat about the other side of the coin. We need to talk about risk, because it's absolutely crucial to understand that investing is never, ever a sure thing.
Seriously, I want you to really let this sink in. The stock market is not a guaranteed income source. It's just not. If anyone ever tells you it's some kind of magic money machine where you're guaranteed to win, they're not telling you the whole story. Plain and simple.
Remember our pizza slice? Well, the value of that slice can go down just as easily as it can go up. Prices are bouncing around every single day because of, well, a million different reasons. And that is exactly why knowledge is your most important tool. You got to do your homework. Understanding the company you're putting your money into is really the only way to get comfortable with those ups and downs.
So there you have it. You now get the core idea, right? A share is just a slice of ownership in a company. You buy and sell it in a giant marketplace, and there's a potential for some pretty great rewards, but also the very real reality of risk. And that leaves us with a big question, the one you have to ask yourself. Is that potential reward worth the risk? That's a question only you can answer.